Understanding the cash flow statement composition. The cash flow statement summarizes the net changes in accounts balances to calculate the ending cash reported in the balance sheet at the end of an accounting period. The importance of the cash flow statement is derived from understanding the sources and uses impacting the cash position of a company. There are two methods for presenting the cash flow statement: the indirect method and the direct method. The indirect method starts with net income and adjusts for non-cash transactions and changes working capital. The direct method only considers the actual cash transactions in a period and does not modify the accrual accounting to cash basis. The cash flow statement is divided into three sections that highlights changes derived from operating activities, investing activities, and financing activities. Cash flow from operating activities derived from changes resulting from working capital and profit and loss statement items. Cash flow from investing activities derived from changes resulting from the purchase or sale of assets and investments. Cash flow from financing activities derived from changes resulting in debt and shareholders' equity accounts. To calculate the cash flow statement, an analyst needs a recent profit and loss statement and two respective balance sheet statements. The primary rule governing the composition of the cash flow statement. When assets increase, this means that the company has utilized its cash balances to purchase or invest in new assets. For example, an increase in accounts receivable translates into more cash stored away instead of being collected, reflecting an outflow of cash balances. When liabilities or shareholders' equity increase, this means that sources of cash were secured to finance a company's operations. For example, an increase in accounts payable translates into storing cash inside the company instead of paying to suppliers, reflecting an inflow. The indirect method in calculating the cash flow from operations starts with adding net profit from the P&L, then adjusting it by and adding back non-cash items and working capital changes. Cash flow from investing activities sums the inflows from assets and investment sales and disposals. It also reflects the cash outflow from making new investments. Cash flow from financing activities sums the changes in debt and equity accounts. As retained earnings includes the net profits of the period. It is essential to avoid double counting the net profits added in the cash flow from operating activities. The ending cash balance is calculated by reconciling the net sources and uses of cash during the period from the three cash flow sections, with the beginning cash balance. The cash flow statement can help management and analysts better understand the spending pattern health. A mature company is expected to generate a positive cash flow from operating activities, unless there are new growth opportunities requiring a business model pivot. On the contrary, a company in growth phase is expected to have a negative cash flow from operating and investing activities, indicated by an increasing working capital and investment outflows financed through debt and equity injections. Follow Femto and activate the bell for more FP&A educational content.